Within the world of corporate governance, there has hardly been a more important recent development than the rise of the Big Three asset managers: Vanguard, State Street Global Advisors, and Blackrock. These asset managers now represent some of the largest owners of U.S. public companies.
They're pretty much running everything.
Yeah.
S&P 500, the number that 88% of the companies on S&P 500, 88% of them, the largest shareholder of those companies is either State Street, Blackrock, or Vanguard.
Since 2008, a massive shift has occurred from active toward passive investment strategies. The passive index fund industry is dominated by Blackrock, Vanguard, and State Street. The Big Three combined constitute the largest owner in 438 of the 500 most important American corporations, or roughly in 88% of all member firms. These 438 co-owned corporations account for about 82% of S&P 500 market capitalization. Large companies where the Big Three are not the main shareholders are typically dominated by private individuals. Companies like Berkshire Hathaway, ran by Warren Buffett, Amazon.com by Jeff Bezos, Facebook by Mark Zuckerberg, the list goes on. In contrast to active funds, they hold relatively illiquid and permanent ownership positions. As a result, there are different views regarding the motivations and opportunities for active shareholder power. Some believe that because passive investors cannot exit, they have little shareholder power, but others argue that this gives them more motivation to actively influence corporations. The Big Three do utilize centralized corporate governance practices and coordinated voting strategies. Nevertheless, they typically support management, with the exception of director re-elections. But again, they may exercise hidden power in two ways. First, through private interactions with invested company management, and second, because company executives may be prone to internalizing the Big Three's goals.
And since it controls significant portions of social media, well, it can influence social media. Since it controls all these news outlets across the world, it can control the messaging that's being given out.
Between 2008 and 2015, investors sold their holdings in actively managed equity mutual funds worth about $800 billion, while simultaneously purchasing passively managed funds worth about $1 trillion, a historically unprecedented change in investor behavior. Passive index funds manage total assets invested in equities of more than $4 trillion as of 2015. BlackRock, Vanguard, and State Street are the only asset management companies that control this sizable and expanding sector. They have recently accumulated sizable shareholdings in tens of thousands of publicly traded companies, both domestically and abroad. The Big Three now control a far greater share of corporate ownership thanks to the growth of passive index funds. A fundamental change in the nature of the new finance capitalism can be seen in the rise of the Big Three over the past 10 years. Contrary to active mutual funds, the majority of passive index funds mimic already existing stock indices by purchasing shares of the index's constituent companies, or in the case of indices made up of small firms with less liquid stocks, a representative selection of stocks, and holding them forever. The effects of combining concentrated ownership with passive investment strategies are a hotly debated topic at the moment. On the one hand, because they merely seek to duplicate the performance of a group of firms, passive investors have little incentive to be concerned with firm-level governance performance. On the other hand, because passive asset managers can use the voting rights of the shares that their funds own, the concentration of corporate ownership may result in a reconcentration of corporate control. So it might be true because there are signs that the Big Three are starting to actively influence the corporations in which they hold ownership stakes. It's true that BlackRock and the other big passive holders' vote often determines the outcome. Between 2014 and 2015, there were nearly 20 unsuccessful shareholder proposals on environmental and social issues that would have passed had BlackRock, Vanguard, or State Street supported them. Michelle Edkins said she believes her team can have influence in about 1,200 of the U.S. companies owned by its passive funds because of the size of BlackRock's stake or the company's structure. She said meetings behind closed doors can go further than votes against management, and that BlackRock typically gives companies a year to change before casting a dissenting vote. BlackRock controlled 8.08% of drug maker Mylan, making it the third biggest shareholder. In meetings with the company a few years ago, BlackRock raised concerns about executive compensation and the company's leadership structure. Dissatisfied with changes that followed, BlackRock voted against the company's executive pay and the directors on the compensation committee at the annual meeting. Mylan has said its shareholders approved its executive compensation packages. It has since come under fire for price increases on its EpiPen, which in turn has drawn attention to its executive compensation. BlackRock's was a sought-after vote when it proposed an $18 billion merger between professional service providers Towers Watson and Willis Group. Towers Watson investors were upset about the proposed terms, a package of cash and shares in the combined company worth less than Towers' stock price when the deal was announced. Proxy advisors Institutional Shareholder Services Incorporated and Glass, Lewis & Co. both recommended voting against it. BlackRock's passive team leaned toward voting no, but portfolio managers at the firm's actively managed funds backed the deal, arguing that it would create more long-term value. The active managers persuaded their colleagues to do the same. Investor Jeffrey Osher and his advisors one day arrived at the annual meeting of Green Dot Corp, a prepaid card company, thinking they had enough votes to remove its chief executive from the board. In the parking lot, they discovered that was no longer true. Index fund giant Vanguard Group, the fourth biggest shareholder, changed its vote over the prior weekend to support the CEO. The reversal was a reminder of who now has leverage over America's corporate boards. Another example of their influence is the case of ExxonMobil in 2021. Shareholders led by Engine No. 1, an activist hedge fund, sought to elect board members who would push the company toward a more aggressive climate change strategy. Large institutional investors, including Vanguard and BlackRock, supported some of Engine No. 1's board nominees. This resulted in a significant board shakeup at ExxonMobil, reflecting the growing influence of ESG-focused investing. In essence, these asset managers have the potential to shape corporate governance practices by using their voting power, engaging with companies, and advocating for changes that align with the interests and concerns of their clients and broader stakeholders. Their influence has been growing, particularly in areas related to sustainability and responsible corporate behavior. Large asset management firms like Vanguard, BlackRock, and State Street can indirectly influence United States politics through their significant ownership stakes in publicly traded companies. While they do not engage in political lobbying or campaign contributions in the same way that some corporations and interest groups do, their influence on corporate governance can have political implications. In recent years, there has been increased scrutiny and debate regarding the transparency of corporate political spending. Many large companies make political contributions to support candidates, parties, or causes, often through political action committees or other channels. Asset management firms, as major shareholders in these companies, have the ability to influence corporate policies regarding political spending and disclosure. Shareholders, including these firms, can file resolutions or engage in dialogue with companies to push for greater transparency and accountability in political contributions. For instance, BlackRock, as one of the largest institutional investors globally, has been more proactive in advocating for greater corporate disclosure of political contributions. They have engaged with companies to encourage them to disclose their political spending and have supported shareholder resolutions calling for such disclosure. The influence here lies in the fact that when large asset managers like BlackRock take a stance on issues like political contributions disclosure, it can send a strong signal to the companies they invest in. Companies may be more inclined to adopt transparency measures in response to investor pressure, including pressure from these influential asset managers. Additionally, these asset managers have started incorporating environmental, social, and governance factors into their investment decisions. This can indirectly impact political dynamics, as ESG considerations may include issues related to climate change, diversity, labor practices, and more. Companies that improve their ESG performance in response to investor demands may also adjust their political activities and positions to align with these considerations. While this influence is indirect and primarily focused on corporate governance and disclosure, it can have ripple effects on political discourse and decision-making, especially in areas where corporate interests intersect with political agendas. It's important to note that these asset managers typically act in the interests of their clients, and their advocacy for transparency and responsible corporate behavior is driven by investor concerns and evolving market trends. This big three names have a substantial influence over financial markets globally. Their combined assets under management reach trillions of dollars, making them some of the largest institutional investors in the world. This influence is primarily derived from their dominant roles in passive investing through index funds and exchange-traded funds. These firms are major players in the world of passive investing, which involves tracking the performance of market indexes like the S&P 500 rather than actively selecting individual securities. Investors are drawn to passive strategies for their lower fees and broader market exposure. Blackrock, for example, offers popular ETFs under its A-Shares brand, while Vanguard is renowned for its low-cost index mutual funds. One key aspect of their influence lies in their responsibility for creating and managing these index tracking funds. They decide which stocks and bonds are included in these funds, a process that directly impacts the composition of market indexes. Given their massive AUM, they effectively shape the holdings of these indexes and influence the performance of the underlying securities. The result is that when these asset managers adjust their holdings within their index funds or ETFs, it can lead to significant buying or selling activity in the stocks and bonds that constitute those indexes. Since they are primarily invested in the largest and most widely traded companies, their trading activities can sway the prices of these stocks. This can create both short-term fluctuations and long-term trends in the market. Furthermore, their influence extends to the sectors and industries in which they invest heavily. For example, if they make substantial changes to their holdings in a particular sector, it can impact the overall performance and valuation of that sector. In essence, their actions can affect the allocation of capital within the market, potentially favoring certain industries over others. While these firms have been credited with democratizing investing and driving down fees for individual investors, their dominance has raised concerns. Critics argue that their immense size and market influence can lead to reduced competition, distortions in asset prices, and less efficient price discovery. It also raises questions about their responsibilities as stewards of corporate governance when they hold significant voting power in the companies they invest in. In recent years, these asset managers have become increasingly involved in advocating for responsible investing practices, including environmental, social, and governance considerations. Their stance on ESG issues can also influence corporate behavior and, by extension, market dynamics. Consequently, their influence on the market is not limited to investment decisions, but extends to broader issues related to sustainability, social responsibility, and corporate governance. Overall, the influence of Blackrock, Vanguard, and State Street in the financial markets is undeniable, and it has far-reaching implications for how investments are managed, how companies are governed, and how markets function. While they offer opportunities for diversification and low-cost investing, their dominance also prompts discussions about market concentration, transparency, and their role in shaping the future of finance.